expensive effort, Katie.
A very expensive effort. It's going to be interesting to see how that moves through Congress, with Joe Biden promising yesterday that the federal government would pay for that effort. Bloomberg's Kaylee Lines, thank you so much, reporting live from Baltimore. And for more on the implications for the port and supply chains, I'm pleased to say we're joined now by Jonathan Salama. He is the CEO of Transfix. Transfix, of course, is a software company that helps shippers and carriers become more efficient. And Jonathan, in the notes that you sent over to our producers, you write that the 24 to 48 hours after are critical for the impacted shippers. Why is that?
First, I want to mention that our thoughts are with the families and anyone injured or missing, and our thanks to all first responders and recovery team. In disaster like this one, or the bridge that collapsed by Philadelphia last year, the first 24 hours are critical. Everyone in the industry really has to think about what are the other options available than this specific route, and how we keep freight moving.
So let's talk about those options, though. When it comes to other routes, the thought has been suggested that maybe this isn't as debilitating as it could be just from a shipping perspective, because you have Philly nearby, you have Norfolk as well. How are you thinking about that, and what are your clients thinking about?
Yeah, as of right now, we're not seeing an impact, but the port is also closed, right? So there is a lot of less freight movement happening right now on the ground, and our customers and other parties in the industry are trying to understand where can this freight start coming from, and how does it get to their final destinations. I think once the port is reopened, not having the bridge might have a significant impact, and we'll have to plan for that and understand when. We'll have to understand a clear path of when is the port being reopened and when is that bridge being going to be done.
Well, let's talk about the potential timeline here. Of course, a very fluid situation. Again, we did hear from President Biden yesterday saying that the aim is to get the Port of Baltimore running as soon as possible. But of course, they need to clear the channel before ship traffic can resume. What kind of possibilities are you modeling for, are your customers modeling for, when it comes to the length of time that this passageway could be closed?
We're modeling a lot of different scenarios, but there is significant amount of adjacent road that we can understand traffic patterns over time and understand what is the most ideal reroutes around that bridge to get to our destination. So it's a lot of modeling around routes and specifically rate per mile as time moves and traffic builds up.
Well, it's also not just the port that we're talking about here. It's the roads surrounding the bridge and the port as well. You have I-95 and I-695. What is the potential impact when it comes to trucking, for example?
Yeah, that's mainly what we focus on, right? We fully focused on trucking, and last 24 hours, we haven't seen an impact, whether it's on price of the transportation or on any bottleneck. The next 24 hours are going to be as important to monitor. And like mentioned before, like when the port is reopened, understanding what bottleneck is going to be created on I-95 is going to be crucial. But we're not going to know until we know.
Not going to know until we know. And I mean, how are you thinking about what short term looks like? Is that a couple of weeks versus long term? I assume we're talking about months there.
Yeah, the timelines are long, and we don't control any of them. No one does, right? Until we understand what the government is going to do and their plan, we have to plan for the long term. We have to plan like this is status quo and how we're going to move forward from here. I-95 is going to become that main point. This bridge in particular was hauling a lot of hazmat and specifically diesel fuel. And so now we have to understand where else can that fuel go through, and if there's going to be an impact on that specific commodity.
And Jonathan, as you know extremely well from your seat, supply chain issues are something that, of course, companies and the broader public have become very familiar with over the past couple of years. And actually, I was having an interesting conversation with the CFO of Ford yesterday, saying that this situation, it could lengthen their supply chains, but supply chains have become more flexible coming out of the pandemic, and maybe that would blunt some of the impact we might have seen otherwise. I'm curious for your thoughts on that thesis.
Yeah, that is absolutely correct. In our view, we've been working. AI has made his way into our industry, and as we're becoming more technologically advanced as an industry, we can clearly see a path where we're becoming more nimble in these situations. If this happened pre-COVID, I think this would have been a lot harder to handle. But as of right now, we're used to be nimble, where it's part of the day-to-day. There's a new crisis happening, unfortunately, too often. And that's what we have to do. And we use a lot of very advanced tech in order to get through these times.
All right, Jonathan, really great to get your perspective on this issue. Really appreciate your time. That is Jonathan Salama. He is the CEO of Transfix. Now, coming up, Robinhood going for gold. Literally, the trading platform is introducing a new credit card, and it's made from 10-karat gold. Details on the bling next. This is Bloomberg. Robinhood, you probably know them as a trading platform, but the company is unveiling a new credit card, and the Gold Card is going to offer 3% back on all purchases. Joining us now with more is Bloomberg's Ed Ludlow. And Ed, what's the vision here? Is this just diversifying revenues?
Yeah, more than diversifying revenues. I think Robinhood's trying to break away from what it's known for, which is retail brokerages, right? And it's not the first time they've ventured into a new financial product. You know, they've done retirement accounts, which have really boomed in their first 12 to 14 months of being set up. But this is interesting, right? You know, it seems like a basic thing, 3% cashback, but that's on all categories. You know, how often do people discuss their credit card perks? And you look at what's out there in the marketplace, you know, often a credit card will offer a cashback on specific category, fuel, groceries, whatever it may be, travel. So I'm interested to see how Robinhood sustains this, where it fits in the business model.
Yeah, absolutely. And most people don't talk about those things, but I feel like in the Bloomberg building, actually, a lot of my conversations end up bringing that up. But that's a different conversation. So when it comes to this push by Robinhood, you mentioned, of course, that they have a retirement product. But when it comes to the credit card, last year, I believe, they actually bought a credit card issuer. So this push has been in the works for a while.
Yeah, so they bought X1 Inc. That was a piece of business just south of $100 million. And Deepak Rao, who was the co-founder of X1, was integrated into Robinhood. Robinhood made him the GM of the credit card business. And I'm interested in how this works from a technology perspective as well, right? So you go into the sort of legacy Robinhood brokerage app. There is a separate part of the app or a standalone division of it that's related to the credit card. They are setting up virtual cards as well that have temporary numbers. So they're kind of saying, well, look, this is secure. This is a flexible way of spending. It does seem like they've been waiting on this for a long time. And if anyone's this morning's been on social media, you'll see that Robinhood are making a very big deal of it. I think the stock has pared its gains to about 2%, but it had been up a lot when they announced this.
Yeah, absolutely. I think 8% or to the tune of that. So, Ed, you have a great interview coming up, of course, with the CEO of Robinhood. Just quickly, give us a preview of what you're going to talk about.
So I do think we want to know how they sustain and fund this, right? You know, if you offer a competitive credit card, you're often a very large financial institution making a lot of money elsewhere. So interested in that. And it's the first time I've got to speak to him since Dumb Money, and I can't resist the urge, so I think I got to ask about that too.
All right, really looking forward to that conversation. That is Bloomberg's Ed Ludlow. Of course, check him on Bloomberg Technology right after this show. But don't go anywhere right now because we have a great conversation with Kim Forrest. She is Boca Capital CIO and founder, joining me right now. Kim, it's great to have you with me. Talk to me about markets at this juncture. I feel like this is kind of a throwaway week. It doesn't really feel like anything is happening. But what's the next catalyst that you're really paying attention to?
Well, I think this is a tread water sort of week because we're all waiting for the PCE, which we can't trade on until Monday. So it's going to be kind of I would say, an upward bias the next couple of days, I think, because we've traded lower. And I'm glad personally to see the small caps coming back. I always like that. But I do think that we are looking for that catalyst, which has been the Fed, but we're moving now into the more dull parts of the year. Although we do have to get through earnings season in April. But it doesn't feel like companies have been changing that much. So it's probably going to reiterate what we heard in the first quarter.
Yeah, it feels like we do have some idiosyncratic stories to go off of, but let's seize on small caps for a moment because actually I've had a ton of conversations about small caps this week, which probably speaks to the fact that it's kind of a tread water week, but I'm hearing a lot of bullishness when it comes to those smaller companies, which is interesting to me, Kim, because of course we've seen a lot of Fed cuts get priced out of the market, and you think about all of these smaller companies with maybe not the best balance sheets, I would think that they would kind of struggle in this higher for longer environment.
Well, I think it's even the hope of the Fed cutting rates that will accelerate these companies, and that could be a little bit of it. Another thing is there are a lot of high quality companies in that small company bag. And if you look through there and find them, you could find a real treasure. The other thing is I think a lot of people make the mostly faulty assumption that because a company is small, it only works in its geography in which it resides. And that's wrong. A lot of the higher quality companies that we like and look at have global operations, and they just are niche players. So I don't believe all small companies are created equal, and you really need to dig in there, and you can find some gems.
You can find some gems. I hear that over and over again, and I'm kind of wondering what the mindset of a small cap investor is. Are you trying to identify the companies that can graduate and become mid cap, large cap one day, or is that too reductive?
Well, let's just make a definition here. I don't really have the stomach for companies that have a market cap below $1 billion. So I'm sort of a SMID sort of person. But that being said, yes, in my large cap companies and small cap companies, I look for exactly the same things. And it's usually a process around product creation. It's called product marketing. And small companies can have these, big companies can have these, and market cap companies of any size cannot have this. But I think keying on who their customer is and providing customer delight is really essential. So that's what kind of gets you in the spotlight for a stock pick from me.
Okay, so kind of looking for the rising stars. That's obviously a strategy in the credit markets, and maybe it applies here as well. Let's talk about the spiritual opposite. Let's talk about one of the biggest companies out there, and that is NVIDIA, because you make some really interesting points in your notes that NVIDIA, they can charge a premium for their chips. They are in such high demand, but as an investor, maybe there's better places to look.
Yeah, I mean, it's funny. I was a software engineer before I got into this gig. And if you would have told me I would be talking about the culture of companies, I would have laughed and laughed because I didn't really think that way. But being an investor for these last 25 years, culture matters. And the DNA of NVIDIA is to make the bleeding edge products and charge bleeding edge prices. And I don't believe that they're ever going to back off of that, or maybe if a CEO change happens, but that is not what they do. So we kind of like AMD and Intel because we think they can scale up what they already have. Like AMD has always had great graphics processors, which is essentially what an AI chip is. And we think Intel can benefit by being the maker of whoever designs them in their fab strategy. So we think that as the build-out continues of AI, that more and more companies that are building data centers specifically for AI are going to watch their budgets. And they're going to come down the budget scale, and maybe companies like Intel and AMD are going to be able to prosper.
And you also make the good point that, I mean, when it comes to sort of playing along the AI theme in general, it's not just the chip makers that you should be looking at. There's a lot of data, and it needs to live somewhere.
Right, right. And this is one of the reasons why AI hasn't taken off in the past. Having been somebody that worked with neural networks, which is the root of what the AI that we're talking about uses, it has to have a lot of data, masses of data. And we didn't have the right data back in the day, but now we have tons of data. It's going to be used by AI, and it has to be stored somewhere because you have to train and retrain and test and do all these processes, and it uses data. So we like Micron because of its non-volatile memory. They're called NAND chips. And we were rewarded just recently because, you know, they said, hey, this stuff is selling like hotcakes. So, and I believe it's largely because of AI.
Yeah, Micron up about 97% over the past year. Not too bad there. So, okay, we're talking about tech. We're talking about AI. I also want to quickly end, of course, what we're seeing with the retailers, sort of that consumer discretionary spend, because we got through retail earnings, and Kim, they were a little mixed, but in the same way that, you know, you're searching for gems when it comes to the small caps, surely there's some good retail names out there as well.
Sure. And I think part of the reason why I am always encouraged about looking at consumer discretionary is we get bored. Even though we like to shop at some place, we kind of get bored and we move on. So I'm always looking for a company that is thrilling their clients, their customers. And Urban Outfitters, you can give me a big eye roll on that one, but they have 3 brands. Urban Outfitters, which is the teen and kind of college age segment, and then Free People and Anthropologie, which skews to a higher income, a client. The 2 that are skewing to the higher income client have been just on fire. Anthropologie and Free People have been doing really well. And we think that because they're bringing in a new president to rejigger Urban Outfitters that this company may be able to grow even more than they have been in the recent past.
All right, Kim, sadly, we've got to leave it there. Always enjoy speaking to you. Our big thanks, of course, to Kim Forrest of Boca Capital. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg. All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, GameStop dropping like a rock after reporting plunging revenue. The meme stock darling also said it was cutting jobs as it tries to contend with weak consumer spending and increased competition. Next up, Canada Goose getting cooked by climate change. The Toronto-based retailer announcing it will cut 17% of its corporate workforce. Sales hit thanks to unseasonably warm temperatures in the U.S. And finally, we have H&M, of course, reporting today, and it's making a lot of buzz. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Coming up, we're going to speak to Glenn Kelman, the CEO of Redfin. U.S. mortgage applications, they fell 0.7% last week, according to the Mortgage Bankers Association, as high rates still keeping the buyers away. For more on the housing market, we're joined now by Bloomberg's Abigail Doolittle.
Well, Katie, this chart really shows us some of the pain that we are seeing as rates are relatively high. We can go back to coming out of the great financial crisis, and you can see in terms of these are the mortgage applications, the purchases, a relatively low level, but take a look at the pandemic, trying to go back up toward pre-financial crisis levels, and right now we're back toward the lowest levels that we've had over this time period. So as to you were mentioning, higher rates keeping some purchasers out of the markets. Now that said, delinquencies are also very low, so it's not necessarily a dire situation. If we go back to the great financial crisis, we can see delinquencies coming out of it as a lot of those homes, those mortgages that were made on terms that weren't really appropriate, tons of delinquencies. In early 2020, a similar story, but we're low. So again, this is some measure of the health of the market. And then finally, though, relative to making a mortgage payment, if we go into the Bloomberg terminal, what we are going to see here is that the average 30-year mortgage payment of 20% down, it's kind of in this range right here. The weekly earnings flatlining. A little bit of a tough relationship here, given the fact that has spiked so much over the last 2 years, Katie.
All right, Bloomberg's Abigail Doolittle, thank you so much. And for more on the housing market, let's keep this conversation going with Glenn Kelman. He is the CEO of online real estate firm Redfin. Glenn, great to have you with me. I want to get to the dynamics of the housing market, but let's actually start with the National Association of Retailers. Recently, a class action settlement over agent commissions, which theoretically should lower the agent commissions that are paid. Do you think that this will change the experience of buying and selling homes in the U.S.?
It could. The jury is still out on how enforceable that settlement is, so it's hard to say. On one hand, the courts and regulators are trying to insist that buyers should be able to hire their own agents, which would put pressure on the fees paid to a buyer's agent. On the other hand, the industry is looking for other ways to cooperate, so we don't know yet how the rule changes will actually be enforced. The changes are supposed to go into effect in July, and so far we haven't seen much change in the amount of pay offered to a buyer's agent.
Well, to that point, I mean, do you think the settlement goes far enough?
That's an interesting question. I think the real challenge is whether the settlement can be enforced.
And so, of course, like you said, the jury's still held on whether this can be enforced. But let's say it is enforced. Do you think that it is significant enough to really change the day-to-day dynamics of the housing market? Specifically, do you think that it will change seller or buyer behavior?
Well, I think if regulators in the courts require buyers to pay their own agent, we'll see the same pressure on the fees paid to a buyer's agent that you already see with a listing agent. So the average commission in the United States could come down. More people may sell their home directly to a buyer without even involving a buyer's agent. So it could be a significant change, but it just depends on whether the settlement can be enforced. It depends on what regulators take further steps. There are still many open questions that have to be answered. But it could be a significant change. And I think what would happen is that people selling their homes would have more money in their pocket from the proceeds of the sale.
So we'll put a pin in that for now, but would love to pick up this conversation, of course, as we get more details. But let's talk about the actual dynamics of the housing market. Of course, supply has been the conversation, this real undersupply that we have, structurally speaking. We did see a little bit of an uptick if you look at the data recently, and I'm curious from where you're sitting, do you think that that's sustainable?
We'll see. So demand from home sellers to put their property on the market has been higher than we expected. So just for our own brokerage, we have a 33% increase in people asking to sell their home. Across the industry, you see a 15% increase in the number of listings hitting the market. For years, the market has been inventory constrained. So even as rates went up and buyers receded, we didn't have enough homes for sale. Now we're getting more homes on the market. It's not because there's been been any easing in rates. It's really been a byproduct of people just wanting to move on. They were able to put off their plans in 2023, but I think it's hard to do that for a second year. So we're talking to more people who say, I just have to move. The problem now is that home buyer demand is relatively flat. Some of that is because home affordability is at a record low, and some of it is because there is so much anxiety about what's happening in the industry that people are still trying to process that.
And I love these conversations because it's a conversation, of course, about interest rates, et cetera, but it's also a story about human psychology, like you're talking about. There's people who've been trying to sell their home or wanting to, they've been waiting for so long and just need to move. Are there people on the other side who need to buy, who have been waiting around for rates to drop, starting to get a little bit of relief, and this actually translates into sales volume?
Yes, absolutely. I think that's the bigger societal problem, that there are so many Gen Z folks, millennial folks really, who are coming of age, wanting to buy a house. They're 31, they're 32, they're 33. They're ready to have children and get a place of their own, and yet they can't afford it. So I think the real issue is that young people today are being shut out of the American dream, and we just haven't figured out how to build enough housing to make affordable housing a reality. And the real pinch point in the market is at homes below $500,000. That's where investor activity is extreme. That's where supply is low. You see an all-time high in the number of investors buying properties just because the market favors the cash buyer so strongly. So I think there's a real issue that society is just freezing up, that people can't move to where they want to move. They can't start a family and make the plans in their life that they want to because of this housing crunch.
Well, let's talk about what those millennials are doing instead, and they're renting their homes if they can't buy in specific situations. Are you seeing any trends when it comes to home prices versus rental prices?
Well, I think there's been more easing in the rental market, so rents overall are up, but if you look at asking rents, what people are paying when they move into a new place, there has been some softness there just because even though we're supply constrained on the purchase side, that has been less true on the rental side. There's so many buildings that are opening. They are scrambling to fill those buildings. And so there is some easing on the rental side, which may be behind why there's an easing in purchase demand. Sometimes when rents just get too dang high, people are forced into buying a home. They just think this doesn't make any sense. I should just pay my mortgage instead of pay my landlord. There's less pressure on those people right now because rents aren't going up as fast as they once were.
Exactly. It all comes back to the math of the monthly payments and which of those numbers is lower, of course. So we're having this broad brushstrokes conversation. Are there any individual markets or regions that stick out to you as outliers?
Well, I think a market like Austin, Texas is really going through a massive change. So mostly home prices have not softened because, as I've said, we've been inventory constrained. So normally when sales volume plummets, you also see a softening in prices, and we haven't seen that except in a place like Austin, Texas. It's a fairly small market, boom and bust. During the pandemic, so many people moved to Texas. I think some of this is a return to office. Some of this is a realization about how high property taxes are in a state that doesn't have income taxes. But most of it is that prices just went up so fast in Austin, Texas, and now they're coming down. And it's just wreaking havoc on the people who live there, who have always lived there, to see prices go up that much and now to see them come down.
Well, Glenn, really enjoyed this conversation. Of course, always fascinating to talk about what's going on in the housing market. It's been frozen for so long. Our thanks to Glenn Kelman of Redfin. Of course, an interesting comparison, too, about the rental market versus the actual home buying market. Let's get a check on these equity markets, though. We're going to do that with Bloomberg's Abigail Doolittle.
So overall, Katie, we're looking at smaller moves. The NASDAQ 100 right now down less than 0.1%, but you can see there's some volatility with it. These are the NASDAQ 100 future, so overnight for the most part during the Asian session higher, and then around the time of the open we've seen some cooling. Some of this could have to do with consolidation. If we take a look at the movers beneath the surface, interestingly, Apple, after lots of bearish action and negative headlines around the iPhone, particularly relative to shipments out of China, you can see up 1.4%. The stock, though, still in a correction from its December peak. Intel up 3.2%. To the downside, though, and one reason that we have the NASDAQ 100 dragging is NVIDIA, down 2.5%. There doesn't appear to be a real reason to it, but I think that it's that rally, that robust rally, some of that strength coming off the froth that some are talking about. And that may too be the case with Broadcom right now, down about 1.4%. When we put this together with the NASDAQ 100, the technicals, this chart really appears as though it is bearish. Maybe not right away, but we've looked at this chart before, and now it is starting to do something that you don't want to see a chart do. So over the last few years, you can see the NASDAQ 100, this daily chart, widely trading in this range. And then here's the big rally out of the October trend. Not quite parabolic, but very steep. Now, why you use a trend line is not to necessarily look at the trend, measure the trend, because you can just see that. Why use a trend line is to see when the trend is breaking, and that is happening here. The NASDAQ 100 going into a sideways trend, breaking that uptrend, suggesting that we could see some downside ahead. Another reason to believe that, take a look at this bearish divergence that we're seeing right across the board, Katie. The RSI, that momentum indicator, a series of lower highs, telling you that the recent highs are bought on less enthusiasm than last year's highs. It's not a good situation. We don't know quite when this might unravel, but this chart does suggest that maybe some of this froth that many people are talking about could come out at some point over the coming weeks, maybe months.
Seems like people across the board just a little bit tired, less enthusiastic. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, I'm pleased to say we're going to be joined by Dr. Helene Gayle. She is president of Spelman College. That conversation coming up next. This is Bloomberg. right, it's time now for our daily Wall Street Week segment. And today, we're looking at the state of higher education, specifically at Spelman College and other HBCUs. Dr. Helene Gayle, president of Spelman College, and Wall Street Week host David Weston join us now. And David, I know that you're particularly interested in the management of universities.
Well, exactly. It's so expensive, and we hear so much about student debt. I just wonder how this is going to all work out. So, Dr. Gayle, thank you so much for being with us. Give us this perspective from Spelman's point of view, from your students' point of view. How do they afford college these days? And is this really sustainable? Because the price has been going up, and we've seen the debt's been going up as well.
Yeah, so thank you very much. It's such an important question. Spelman College is a private college, and so different than public institutions, we don't have access to some of the resources that you might have at a school that had a large state appropriation. So, there are probably 2 or 3 ways in which you can have an impact. First of all, getting more scholarship support broadly. 40% or more of our students are Pell eligible, so they come from some of the lowest social economic status families and do get Pell grants through the federal government. Dollars for Pell grants have been increasing, so we hope that our nation will continue to be generous when we think about federal support for college education. The other way is obviously for us to be able to raise more private dollars to be able to give scholarships. And, it's one of the things that is my highest priority, to continue to work to get the kind of resources, add to our endowment, so that we can provide more scholarship aid to our students. Upwards of 75% of our students get some sort of financial aid, either through federal dollars, through our own institutional, through corporate sponsorships, et cetera. So we have to continue to think about how do we make that scholarship support available. We also help students with work-study programs, and those are also incredibly important. But the biggest thing is that costs continue to go up. Supplies continue to go up. What we need to pay our faculty and our staff to be able to meet the needs of today's world. So, while it's hard to contain the cost, I think there's a lot more that we can do to provide support so that our students don't graduate with huge debt,
right.
All while they're trying to start families, start a career, buy their first homes. So that's, my priority number one.
Well, I'd love to talk about the costs that you're facing on your end, because we often have these conversations about tuition, and people point at tuition and say, how could it be so high? And you take a look at Spelman, for example, I believe it costs close to $50,000 a year for on-campus tuition. But what costs have you seen?
Not just for tuition, so
right.
That's all in, including room and board.
Right, so on campus, of course, we're talking about there. But tell us about what cost rises that you're dealing with on your side of the equation, and how you basically get at that tuition level.
Yeah, so we are very tuition dependent. So although we have tried over the last few years, we actually did a resetting of our tuition to actually decrease it a few years ago, and now steadily are adding small increases over time to keep up with the costs. So the costs are, as I mentioned, just the cost of supplies, the cost of meal services, the cost of paying our salaries so that we can continue to have the kind of excellent professors and retain them, and the excellent administration, because the cost of living is going up for everybody, and we've got to be able to keep pace. And of course, for academic institutions, human capital costs are the largest portion of our expenditure. So, that's a big part of it. We live in a world where we're continuing to have higher and higher rents, higher and higher overall living expenses, and we've got to be able to keep pace with that.
Right. Dr. Gayle, here at Bloomberg, we talk about expense. We also talk about investment. And it's been long thought that a college education is an investment. I wonder about the payoff of that investment that you're seeing for Spelman students as they graduate. What's the job opportunity situation, and is it shifting the curriculum you have to make sure that they really are in demand in the job market?
Well, yes, yes, and yes. So first of all, we are proud that we were rated this year, U.S. News and World Report, as the #2 school for social mobility. So that means that our students actually get a good return on their investment. They go out and they do better. They have great economic futures, and they continue to have more opportunity. It is, we put a big focus on making sure that our students are career ready or ready to go on to graduate education if that's what they choose. We work very closely throughout their school years to give them those skills, not only the technical skills, but also the soft skills that will make them very marketable in today's world. We have a program called Braven, for instance, that is obligatory for all of our students, which is a career readiness program that is already shown throughout the country at different schools how much being part of that program and learning those skills, those job skills, makes them so much more marketable. So it's a big focus for us. We know that we've been able to do a good job. And as you mentioned, it's so important that we're looking at the skills that people will need in today's job market. Artificial intelligence, as an example.
Right.
Our students have to understand new technologies if they're going to be ready for tomorrow's job market. And so we want to give them those kinds of skills, core skills that will allow them to be marketable not only for today, but far into the future.
Dr. Gale, I don't want to let you go before I ask about that decision from the Supreme Court last year on admissions, particularly taking into account race and admissions, particularly you as the head of perhaps the most prominent HBCU. How has it affected your admissions process?
Well, I think it's too early to tell. That's a recent decision. But I think, we have seen increase in our applications over the last few years. And I think it's both some of the impact of the Supreme Court decision, but I also think it's the years that came before, the George Floyd, post-George Floyd, Black Lives Matter. I think that it has changed the way young people feel about being in an environment that's nurturing, that they know that they are valued, that they see people that reflect who they are, understand the cultures that they came from. So I think we're seeing across the country increases in applicants to HBCUs. And I do think that the Supreme Court decision had a chilling effect, whether or not it's yet had the time to have a practical impact, but I think it has had a chilling effect on students and feeling like they want to be in a place where they feel that they are welcome, nurtured, and are able to authentically be themselves.
Well, Doctor, unfortunately, we have to leave it there, but really appreciate your time this morning. Our thanks, of course, to Dr. Helene Gayle, the president of Spelman College. David, who else do we have coming up on Wall Street?
So tomorrow we got Josh Bolton, who is the head of the Business Roundtable. He's going to talk to us about the view from the C-suite on the presidential elections coming up. And then on Friday, we're going to have Glenn Hubbard, the economist coming from Columbia Business School, and he's going to talk to us about a pro-growth strategy, whether we have one in this country. That's coming up at 6 p.m. Eastern Time on Friday.
All right, a lot to look forward there to. Thank you to David. This is Bloomberg. All right, let's take a quick look at some stocks hitting highs today, and Disney hitting a 52-week high after UBS raised its price target to $140. The stock has seen a raft of upgrades this week, currently up about 1%. Merck also hitting highs after it won U.S. approval for a new treatment that targets a rare form of high blood pressure. You can see Merck shares certainly celebrating there, up about 4% or so. You take a quick look at these markets right now, and it's quiet, but it is green. The S&P 500 currently up about 0.3%. Different story for big tech. You can see the NASDAQ 100 currently down about 0.1%. And for some reason, small caps leading the way here. The Russell 2000 currently up to the tune of 1%. Now, coming up on Bloomberg Television, we have the CEO of Robinhood. He is going to join Ed Ludlow next on Bloomberg Technology. But that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.